Lots of people out there who really want to retire early, say before age 65-ish, really want to retire, but might not have the savings, the investment portfolio to be able to do that. And one question that comes up pretty frequently is, hey, can I step into an early retirement and use my home equity to fund it? Well, in this video, we're going to cover that concept in a lot of detail. We'll talk about the different ways that you might be able to use your home equity to afford an early retirement. We'll talk about the things that you need to watch out for and how to tell whether this is a good idea for you or not. The first way to do this is simply to sell your home and draw out the equity. Let's say that you bought a house years and years ago for $400,000. Now it's worth $750,000. Well, when you bought it for $400,000, if you had a mortgage, you've probably paid it down a little bit over that time frame to where you owe less than what you did on day one. So if you sell it for $750,000 today, not only has the price gone up, but the amount of debt that you have to repay upon the sale has probably gone down. Now you have some transaction costs in there as well, right? So if you sell your house and you pull out the cash, the equity that you have in your cash, that can be a really useful addition to your retirement savings and your whole retirement plan. The problem that you run into, obviously, is hey, if you sell your house, where are you going to live? You have to go somewhere else. Maybe if you're living with a family member for, potentially for free or for low cost, that can work. Otherwise, you're just looking at maybe downsizing, buying someplace else for less cost, or renting somewhere. Now, renting can work. I'm not, opposed to renting during retirement by any means. And when you lease a place to live in, like a condo or an apartment or a house, your monthly rent is the maximum amount you're going to pay, which is great, right? And as a homeowner, you probably know that when you own the house and you're paying a mortgage, that mortgage payment is the lowest that you're going to pay. So if something goes wrong with the house, it's actually kind of convenient to be a renter because that's the landlord's problem. That's not your problem. And for some people, it actually does make sense to rent in retirement instead of own because you don't have to come up with cash for all those extra costs. Now, the downside, obviously, is that you don't have total control over where you're living. I've rented places in the past, my wife and I have, that have been sold out from under us, and the buyer wanted to move in and we had to move out. And that's not a great position to be in. Now, it doesn't happen a whole lot with apartment complexes, but depending on where you live, you might be in a rent controlled area, you might not be. And if you're not, as soon as you sign that next lease, your monthly rent might go up by quite a bit. And that's not too desirable either. So this can work in the right circumstances, selling your house, taking the cash out, and then using that cash toward your retirement plan and your portfolio. Now, the other two options here are, well, what if I borrow more against my house? Maybe I bought that $400,000 house years and years ago. Now, not only has the value gone up, but maybe I've paid that mortgage way down, maybe even all the way down to zero. Well, in that case, you have an asset worth $750,000 and no debt against it. So, yeah, you could borrow against the house, take cash out, and add that to your retirement portfolio for use in your retirement plan. That's a reasonable thing to consider. The two variations of this are HELOCs, home equity lines of credit. You approach the bank, they give you a line of credit. Basically, they give you a checkbook, and up to a certain amount, you can just write checks from that account. The bank will cash the checks, they'll make the financing happen. And then every time that you draw on that line, the balance will grow and you'll pay interest on it. Usually, the way that HELOCs are structured is you have a draw period of maybe 2 to sometimes 5 or 10 years where you can spend money on the line. You can go write those checks. The bank will cash them and make the funds go, and the checks will clear. And then after that period is over, the loan repayment will start, and you can no longer draw from the HELOC in its current form, and you have to start repaying that loan. The other form is a home equity loan, where you simply, it's like a second mortgage. You get cash, it's a fixed rate that you repay over, the next 10 to 30 years, circumstances depending. Now, this option Again, it can work, right? Either a HELOC or a home equity loan can work if you have a very, very low mortgage balance. If your loan to value is very, very low, maybe this is something to consider. Generally, we like to reduce debt when we step into retirement, though. And in general, I'm really not a fan of this option because it presents a lot of risk for a normal retirement. A normal retirement, let's say that you're going to retire at 65, you're planning, to be safe to live until 95. That's a 30-year stretch that you're planning for without income. If you're trying to arrange an early retirement by backing that up, maybe to 60 or sometime in your 50s, now not only are you contributing to your retirement accounts for a shorter period of time, but you're planning for a substantially longer retirement. And when we add debt to the equation, that adds risk to the equation too. And that's not desirable for a lot of people. Again, it can work in the right circumstances, but I think my preference would probably be to sell the house, pull the equity, and maybe downsize or rent before we think about borrowing more money in order to finance an early retirement. The other consideration here that kind of buffers that argument is interest rates. Interest rates on second mortgages, home equity loans, and HELOCs they're relatively high right now. They're maybe between 7 and 10% a year. I don't like to be taking on debt at all when transitioning into retirement, and especially not at those kinds of rates. So I would view those as a last option. Now, the other option that we haven't covered yet are reverse mortgages. Reverse mortgages have gotten a bad name over the years because they used to be products that were sold nefariously, and they were really good for lenders and representatives selling the products, and they were really bad for people borrowing the money. And it was kind of a predatory thing. Well, the FHA got involved here maybe 10 years ago, 10, 15 years ago, and basically imposed a bunch of regulations and cleaned a lot of this up. So the FHA backed reverse mortgages that you see in the marketplace today are much more borrower friendly than they were years ago. So I bring that up because if you hear the words reverse mortgage these days, it's not quite as easy as running for the hills and just that being a complete turnoff immediately as it once was. These things can be legitimate options these days. Now there are two flavors of this. One is a reverse mortgage where you take cash out and you repay the loan over the rest of your life. That loan is repaid upon death. And let's say that your kids are going to inherit the house from you. Either they have to repay that reverse mortgage after you die in order for them to inherit the house, or the bank has a right to sell the house, pay off the debt, and whatever is left over, that passes to your beneficiaries. The second form of this is through a line of credit. You take out a reverse mortgage, and then kind of like a HELOC, you have this credit line available to you that's backed by the equity in the house. And if you're someone who's trying to coordinate these pieces, you really want to stay in your house. You're not sure you have the asset base to support it, but you really want to retire early. A reverse mortgage might not be the worst thing to consider, and maybe a line of credit would be the best way to go about it. Again, interest rates are a little bit higher right now, which makes it more expensive than it used to be, but those are the predominant four ways to access the equity in your house in order to retire early. And one of them may or may not be a good fit for you. Here are the things to watch out for if you're planning on retiring early and using home equity to finance it in one of those ways. Number one, you need to pay attention to your debt to income. Excuse me, debt to income. Not coincidentally, is one of the same metrics that lenders are going to use when evaluating whether or not to extend you a loan. Reverse mortgage, HELOC, home equity loan, right? So while you're working, think of your monthly income statement as a household. You have income coming in from work every single month. Then you pay taxes and you have all your monthly expenses. Well, hopefully you have a little bit left over at the end of each month. And every single month, that little bit left over, whether it's being saved in your savings account or deferred into your 401k, that little bit left over is adding to the pile and adding to your net worth. And then at some point, you're hoping that net worth gets to a point where it's big enough to where you have confidence that you can give up the income, you have all your monthly expenses, but the income you have coming in is no longer larger than the expenses going out. So every single month, you're now at a deficit instead of a surplus. So over all those years, you put money in every month to grow the nest egg to become financially independent. Now you're going to take it out of the nest egg every single month to be able to match those two things and remove the deficit from your cash flow. Now, if the loan that you take out against your house, if you're going to use home equity for this, then the loan that you take out is going to have monthly service payments, right? You have to pay back the debt in some way, shape, or form in a HELOC or a home equity loan. So you need to make sure that those payments are not too large a portion of your retirement income based on whatever your retirement plan looks like. If you have a whole bunch of income coming in from annuities and pensions and you're eligible for Social Security, maybe you have the latitude to take out a home equity loan or take out a HELOC. But if not, and you're relying on everything that you've saved and the home equity you're pulling out in order to retire, that's a trickier situation, right? Now, this is another reason I say that reverse mortgages can actually work, because that product is designed to match this imbalance a little bit better. So you need to take a look at your debt to income. You need to take a look at your monthly cash flow after taking out this debt. And again, at this level of interest rates, they're higher right now than they've been in quite some time. Mortgage rates are still right around 7% as I sit here recording this. Debt is more expensive to service and pay back than it was a couple of years ago. So you need to make sure that you're comfortable with that. And if you take out another piece of debt and use your home equity to finance your retirement, make sure you're comfortable from a debt to income standpoint and understand whether it's a variable or fixed rate. Because yeah, rates have gone up. There's absolutely no guarantee they won't go up further from here. And there's a lot of people that took out variable rate loans here a few years ago that are now really taking it on the chin because rates have gone up and their monthly costs have become that much more expensive. So make sure that you don't get too far out on a limb here from a debt to income standpoint, and you're fully understanding of the structure of the loan that you have and the interest rate structure. Now, the third thing that you need to watch out for here has to do with asset liability matching. This is kind of an institutional investment term. When you take out more money from your home equity, right? So presumably you're borrowing more against it. That new liability is adding to your to the money that you owe, and presumably you're getting cash for that, right? So you're creating an asset because you're getting cash, and you're creating a liability because you're adding to your debts. Well, you want to pay attention to what you're doing with that cash that you're pulling out. Again, either through a reverse mortgage, home equity loan, doesn't really matter. If you're taking cash out and you're sticking that cash in the bank, then maybe you're earning a reasonable rate of interest right now because interest rates are higher, 4%, 5% per year. Not bad. But the rate you're paying on the debt is probably higher than that, which makes this a losing proposition. But the cash is always going to be there. Now, if you take out a home equity loan and you take the cash and you add it to an investment portfolio because you think you're going to grow that money at more than 7% a year, which is, I think, a fair assumption over a long period of time, that means that the money that you've taken out is going to grow faster than the debts, and that's a good thing. The problem is that when you invest money in a balanced portfolio like that, there's no guarantee in any one year or in any set of years that your return is going to exceed the rate of interest that you pay. And the best way to describe this is if you look at it over a 30-year horizon, like a long period of time, we're very likely, or I should say a balanced portfolio is very likely to resemble its long-term returns that we've seen over the last 100 years or so, maybe 7-8% per year, something like that. But if you shorten that timeline, the less confidence we have that we're going to resemble that long-term average in any given year. Because guess what happens? We hit a recession, we hit a bear market, the stock market plummets, the value of your portfolio falls, and that's not terribly palatable for a lot of people. If you take $200,000 of home equity out and you invest it in a balanced portfolio, and then the stock market crashes and you're down 30% in 1 year, guess what? 30% of $200,000 is 60 grand. You took out $200,000, you owe $200,000 back to the bank, but that 200 grand that you took out is now only 140, right? So your investment portfolio is going to go like this. The rate that the bank is going to charge you on your home equity loan is going to be steady. They're going to want to charge you that interest every year, rain or shine, no matter what. So what you're planning to do with the home equity that you pull out to finance your retirement is a relevant factor here. Don't go investing it in a whole bunch of cryptocurrency or something that's super volatile, because that's a mismatch between your assets and your liabilities. Your liabilities might be steady. Your asset values are going to bounce up and down quite a bit. So those are the really the things that you need to watch out for if you're considering this. And that's why it makes this a somewhat risky proposition. You're adding to your debt load to retire early, meaning that you're funding a longer period of time in retirement and taking on more risk in order to do that. It makes it a risky proposition. Here's how to tell whether this is a good idea for you or not, right? Number one, you need to look at your monthly spending, your monthly budget, what you forecast that's going to look like over the course of your retirement, and really pay close attention to your fixed versus discretionary expenses. Just like we're talking about with your debt to income ratio, this is the precise reason why lenders use debt to income ratio to evaluate your creditworthiness. It's because if you have too many fixed expenses, you don't have the latitude to adjust if things go south financially for you. So if the vast majority of your monthly living expenses are fixed, you have no discretion over dialing them up or dialing them down already, then by adding more debt, all you're doing is adding to your fixed expenses every single month. And that's kind of a treacherous thing, considering that we're lengthening the timeline of your retirement by considering this in the first place. Okay. So that's a consideration. Secondarily, let's say that you do have a decent portion of your expenses are discretionary. Well, how willing are you to tighten the belt as needed? If things go south and your investments fall again by 20, 30% because the markets crash, which happens periodically, we should expect that over the course of your retirement, especially if you're extending your retirement timeline from 30 to 40 years or longer. This is just going to happen, right? You have to be comfortable being willing to adjust along the way. And at this point, if you're thinking about giving up the job, you probably know yourself pretty well. If that's not you, if that's too uncomfortable, this is probably a good sign this is not a good idea for you, right? Now, that's your willingness to adjust. The other component, the third component here, is your capacity to adjust. And one really important measure there is who else is depending on you. Is it just you? Do you have other family members that you're supporting? Is it you and a spouse, right? This is a risky thing, lengthening the timeline of your retirement. Because again, when you get to the point of retirement, you've worked to pay your expenses and put a little bit of money away into that nest egg every single month over the years. Now the nest egg is big enough to where we think we can walk away from the income and use that nest egg to take money out and pay our expenses over the rest of our life. Okay. So that's a lot of uncertainty making that jump to shut off our income. The longer period of time that we're planning for, the more uncertainty is, the more uncertainty there is, and the longer that period of time that our nest egg is going to have to sustain us. So that's an inherently risky thing, right? And if you have other people depending on you over the course of your retirement, now you're not just making this decision for yourself, you're dragging others in on it as well. So those are three things that I would really strongly consider. What are your fixed versus discretionary expenses? What's your capacity to be able to adjust as things go, as things materialize over the years? And on top of that, what's your willingness to adjust, having been on this earth for a while and being in the position to where you're considering retiring early? So those are the things that I'd consider. Again, this can work. You really have to tread carefully. You have to make sure that the way you're accessing equity is the right for you, and it's aligned with the rest of your financial plan and has a high chance of success. All right, that's it for today. I hope you liked it. If you're watching still, you probably did. So make sure that you hit the like button below and let us know what we missed too. In the comments section, let us know your feedback, what resonated with you. Are there other things that people should consider that we missed? This is helpful for everybody when you leave your feedback.